Your first reaction to this one?
So as we were saying before, I think the Fed focuses a lot on wage growth, and we've seen wage growth above expectations. I think it's really clear that the Fed is going to be waiting a while before it starts cutting rates because the labor market is still quite strong. The wage growth is still quite strong. And wages are the key thing that then feed into services as well as manufacturing inflation.
Randy, not the simple arithmetic of a real wage, but almost just a cultural and societal note. Do you see here wage growth being beneficial across America and that people will have more inflation-adjusted cash in their pockets?
Oh, it's super great to have real wage growth, finally. I mean, we had, even though nominal wages were growing very rapidly, they weren't growing as fast as inflation. And so people were feeling left behind. And they were left behind because they wanted to put food on the table for their families, and the food was a heck of a lot more expensive than it was before. Now they're starting to earn a bit more than inflation, which is great for them. But I think what that's going to mean over time is that, well, when it was great to be hiring people when labor was relatively cheap in real terms, now I think you're going to start to see a little bit of softening of the labor market because it's just not going to be as worthwhile for firms to be hiring when workers were relatively more expensive.
Randy, why is it that we've seen so many downward revisions of the prior months? Does that mean that we can expect a significant downward revision of this upside surprise come the data that we get in February?
Well, this gets back to what Tom was talking about before. The standard deviation has gotten wider. So there's a lot more noise that's in there. I don't think you can take something specific out that it's always going to be downwardly revised. I think we just know that there are going to be some substantial revisions.